Thank you, CA Bhavna and Taxmann team for this opportunity. And so please let me know if my screen is visible.
Yes, it's visible.
Yeah. So good morning to all the participants who are watching this session right now. And so today's agenda is overview of Ind AS. So this 1 hour session will be delivered by myself, Alok Garg, and my fellow speaker, CA Chandni Gupta. And agenda of the day is we'll discuss what is the introduction of. So we'll discuss the introduction of Ind AS. So we'll discuss what is Ind AS, from where this Ind AS has come, what is the relevance of Ind AS. Then we will discuss how these Ind AS are converged with IFRS, or these are the converged IFRS standards. So we'll talk about IFRS because Ind AS are something which came from IFRS. So we need to understand what is IFRS as well. The third agenda will be roadmap for applicability of Ind AS. So as far as roadmap is concerned, because in India there are two kind of accounting standard. One is our accounting standard, and the second one is Indian accounting standard. So we need to understand on which set of entities Ind AS is applicable and on which set of entities AS is applicable. So it is important to understand the roadmap for applicability of Ind AS. So the first half of the session will cover these three important topics, and the second half will be delivered by CA Chandni Gupta, and she will take over on Schedule 3. Schedule 3 is something which talks about the presentation of the financial statements, which talks about the format of the financial statement. She will tell you that what is the relevance of Schedule 3, what is the requirement of the Schedule 3, and what is the importance of Schedule 3 in finalization of the financial statement. Then she will also talk about the major impact of convergence with IFRS on Indian financial statement, because these Ind AS are not the original accounting standard which is applicable to India. So AS are the original standard which was applicable to India since beginning, but these Ind AS was notified and applicable from 1516. So of course there will be an impact. There was an impact from converging from old accounting standard to new Ind AS, and Chandni will tell you what are the major impact while shifting from the earlier regime of AS to new regime of Ind AS. So these are the 5 agenda for the day. And now let's start with the first agenda, introduction of Ind AS. So we have two set of standard. One is accounting standard and the another one is Ind AS, right? So here we are talking about Indian accounting standard. So before understanding Indian accounting standard, let me start with one of the important slide. So in the slide, you will see the picture of 6 gentlemen. The first one is Mike from France. The second one is Mi Chi Pi from Hong Kong. The third one is Morris from Kenya. Fourth one is Muko Ono from Japan. Fifth one is Max from Australia. And last but not the least, Mr. Kejriwal from India. So I've just taken these 6 pictures from Google and I have just put the imaginary name of these pictures, okay, except Mr. Kejriwal. These 6 gentlemen went to London to attend a conference, to attend a meeting. So they have to deliberate on a single topic. They have to discuss with each other. They have to reach at a conclusion. But the problem is, Mike only knows French language. Mi Chi Pi only knows Chinese language. Morris either knows Mandarin or knows English. Muko Ono knows only Japanese language. Max knows English and Mr. Kejriwal knows Hindi. I'm just taking an example. Mr. Kejriwal knows Hindi. Do you think that this meeting will be fruitful? Do you think that they will be able to understand with each other? Some of you will say that they have to use a translator, right? So translator is not a solution. Everyone cannot be Modi ji. If I have to visit some another country, so I cannot carry the translator with me, right? So what could be the general solution of this problem? So we understand that language is a barrier here, because Mr. Kejriwal will not be able to understand French, Chinese, Japanese, English, or more, or let's say Mandarin. Okay. Likewise, Mi Chi Pi will not understand French, Hindi, and Japanese or English. Okay. So they have a problem with each other's language. They will not be able to understand what others are saying, right? So language is the problem here. Language is the barrier here. And what is the solution? The solution is to have a commonly internationally accepted language. For example, English. If everyone knows English, then their life will be simple, right? They will come on a single platform, single stage where they will be able to understand each other. Now, I'm just taking forward my discussion. And here, Mr. Mike, who is from France, wants to invest in a company which is led by Mr. Max, and Mike knows French GAAP, and Max prepare its financial statement in Australian GAAP. Do you know how many legal countries are there in the world? There are 200 countries. And do you know how many gaps are there in the world? There are more than 50 gaps. When I say 50 gaps, French gap, Chinese gap, African gap, Canadian gap, Japanese gap, Indian gap, okay, UK gap, US gap. So a lot of gaps are there in the world. And let me tell you, if you see all these names, so what is common here? You will say gap word is common here. Gap word is common here. But I'll tell you, in this entire name of the gaps, as a finance student or as a finance person, I'll say that gap is not the common word here. The common word here is a prefix, which is name of the country, right? Indian gap, US gap, UK gap, Chinese gap, Hong Kong gap, African gap, Canadian gap, US gap, right? Japanese gap, Hong Kong gap, Chinese gap. So every gap carries the name of the country as a prefix. Now, if I talk about India, so why India wants to go for Chinese gap? If I talk about Hong Kong, why Hong Kong wants to go for French gap? Why France wants to go for Australian gap? Right? Because these are the country specific gaps. And what is the problem here? If they have to invest in each other's company or each other's industry or in an industry of different country, so what is the problem here? They have to understand the financial statement. They have to understand the financial statement, but they will not be able to understand the financial statement. Why? Because everyone knows a different gap. So what is the problem here? The problem is reporting language. The problem is reporting language. Reporting language is the problem here, right? And what could be the solution for this reporting language, for this problem of reporting language? The solution will be have a commonly internationally accepted reporting language, have a commonly internationally accepted gap. And what could be that gap? That gap should be international gap. That gap should be a accounting standard or a gap which is not a country or geography specific. And what could be that gap? That gap will be IFRS. What is the full form of IFRS? International Financial Reporting Standard. And we have seen that every gap carries a country as a prefix, name of the country as a prefix. But in IFRS, there is no any country name. In IFRS, it is International Financial Reporting Standards. And let me tell you, these standards have been designed to cater the entire world. When I say entire world, if any country wants to use IFRS, they can use IFRS. Mind my word, I'm saying use IFRS. Okay, any country wants to use, they can use IFRS. And let me tell you, out of 200 countries, more than 150 countries are using IFRS. In Europe, Europe is using IFRS since 2005, since 1st January 2005. Pakistan is using IFRS. Dubai is using IFRS, right? So these countries are using IFRS. New Zealand is using IFRS. Malaysia, Singapore, India, these are using IFRS, right? These are using IFRS. So the commonly internationally accepted language could be IFRS, and out of 200 countries, more than 150 countries are using IFRS. The total GDP size of the world is close to 95 trillion US dollar. And out of 95 trillion US dollar, more than 50 trillion US dollar is reporting into IFRS. Okay. So this is the prominence of IFRS, which we can see here. Now coming to IFRS. So IFRS are the standards which have been issued since 1973. And these standards have been issued in two parts. One is from 1973 to 2001, 1973 to 2001, and then 2001 to till date. Okay. In 1973, there was a committee known as International Accounting Standard Committee, IASC. International Accounting Standard Committee was formed in 1973 with an agenda to issue global standard, right? And this committee has issued 41 international accounting standard. The name was International Accounting Standard, IAS, 41 IAS. Okay. But so far, only 24 international accounting standards are live. Where these 17 IAS have gone? These 17 IAS have gone or have replaced with 16 IFRS. So let me tell you, from 1973 to 2001, International Accounting Standard Committee has issued 41 international accounting standard. In 2001, this International Accounting Standard Committee was replaced with International Accounting Standard Board, IASB. In 2001, IASB comes into picture and it has replaced IASC. And the agenda of IASB was to review these 41 international accounting standard, and wherever lot of changes were there, they have demised the old standard and they have issued a new standard in the title of IFRS, okay, from 2001. So out of 41 international accounting standard, they have replaced 17 international accounting standard with 16 international financial reporting standard, right? When I say 16, so there were two standard on revenue, IAS 11 and IAS 18. So they have merged these two revenue standard into one IFRS standard, which is IFRS 15. So as of now, there are 16 IFRS which have been issued after 2001, post 2001. And the name of these standard starts with IFRS. Okay, the title starts with IFRS. And there are 24 international accounting standard which is live today, and these are pre 2001. Okay, and the title is IAS, International Accounting Standard. So globally we have 16 IFRS, 24 IAS, and these IAS have been issued pre 2001. IFRS have been issued post 2001. Okay, apart from these standards, we have some interpretations, right? And there are 15 interpretations. I mean to say 15 international financial reporting interpretation committees interpretation. So there are 15 interpretation issued by IFRIC committee, and there are 5 interpretation issued by SIC committee, right? So we have 16 IFRS, we have 24 IAS, okay, and we have 20 interpretations, right? So this is the entire structure of global standard. Now coming to the how to use IFRS. So I have told you that these countries have used IFRS. So IFRS can be used into two manners. One is adoption. What is meant by adoption? Taking as it is, taking others' baby as your baby, as simple as that. Like Europe has adopted IFRS, right? So when you see the balance sheet of European companies, you will find that, for example, when you download the balance sheet of HSBC Holding PLC, you will find that in the basis of preparation para, they used to write the financial statement of HSBC Holding PLC have been prepared using IFRS, International Financial Reporting Standard, which is issued by International Accounting Standard Board and as adopted by European Union and European Financial Reporting Advisory Group. So they say that our financial statement have been prepared by under IFRS, and these IFRS are issued by IASB but adopted by European Union and European Financial Reporting Advisory Group, IFRIG, right? So Europe has adopted IFRS. Middle East, like if you see the Dubai Emirates balance sheet, you will find that they are writing like we have used IFRS in preparation of financial statement. They have adopted IFRS without any change. Pakistan has adopted IFRS, right? And the second mode is convergence. What is meant by convergence? So convergence means taking IFRS literature as it is and then doing some changes as per the suitability of the economy or industry. For example, India has converged IFRS. So India has picked IFRS standards. When I say IFRS, IFRS includes IAS as well. So India has picked these standard and India has done some small changes in these standard. So whenever you are doing even one change in this standard, you cannot call it as a IFRS. Okay, so that is why India has converged IFRS, because India has done some changes in IFRS standards, and that is why we are calling it as a Ind AS, Indian Accounting Standards. Malaysia has converged IFRS because Malaysia has done some changes. That is why they are calling it as a Malaysian Financial Reporting Standard. Singapore has converged IFRS. That is why they are calling it as a Singapore Financial Reporting Standards. Hong Kong has converged IFRS. That is why they're calling as a Hong Kong Financial Reporting Standards. Bhutan has converged IFRS. That is why they are calling it as a Bhutanese Financial Reporting Standards. Right? Is it clear? Yeah. So when I say convergence, India has converged IFRS. That is why in India we are calling it as a Ind AS, Indian Accounting Standard. And we have done 3 kind of changes while converting this IFRS into Ind AS. And these 3 kind of changes includes carve out, carve in, and removal of option. And let me tell you, our Ind AS are 99% cut copy paste of IFRS, 99%, right? 99% cut copy paste. Only there is a change pertaining to 1%, right? And this 1% has been segregated into three parts. One is carve out. What is meant by carve out? Carve out means using a different treatment, using a different treatment. For example, in global scenario, IFRS says that if a company is acquiring another company, A is acquiring B, and the net assets value of B is 100 rupees and A is paying 80 rupees, right? So A is paying less and A is getting more. So the difference, the IFRS standard says that this difference we will recognize as the other income in the P&L. Okay, so when one is acquiring another company, the difference will go to P&L when it is on a favorable side, right? But in India, what we were doing, we were capitalizing as a capital reserve. We were saying that the acquiring a business or acquiring a company is not an ordinary activity. We cannot recognize income if we are paying less. It should be a capital reserve. So that is why in India, we are deviating from the IFRS treatment, and we said, if we will acquire a company and we will have a profit, so that is not a normal profit. That is not a revenue profit. That is a capital profit and it will go to capital reserve. So we have used a different treatment, right? What is meant by carve-in? So carve-in means a specific guidance in IFRS scenario was not there, but while preparing Ind AS, while drafting Ind AS, we have put an additional guidance. We have incorporated additional guidance. So again, in business combination accounting, we have incorporated a specific guidance. So IFRS says that the business combination accounting has to be taken at fair value, right? All the business combination. But we have said that if there is a group company acquisition, like there are 3-4 group companies and one group company is acquiring another group company, so this is known as a common control acquisition. And we have said that in case of common control acquisition, we will apply book value method. We will not apply fair value method because it is kind of a family acquisition, right? And let me tell you, even International Accounting Standard Board has agreed with our view after 5 years, and now they are also considering this book value method in case of common control acquisition. So 6 months down the line, there will not be any carve-in between IFRS and Ind AS because IASB is going with our view, right? The third one is removal of option. So these are three kind of changes. A removal of option means in IFRS scenario, there are some choices. There are some choices are given. For example, for investment property, for land and building, IFRS says that you can recognize land and building, subsequently recognize land and building either at fair value or at a cost method. But in India, we have said that we will not go by the fair value choice. We will only go by the cost method. We will disclose the fair value of investment property, but we will not recognize the fair value of investment property. So there were two options in IFRS. We have cut down one option, and when we cut down one option, we call it as a removal of option. So in India, 99% cut copy paste IFRS is there when I say Ind AS, okay? But 1% three kind of changes are there. Carve out means having a different treatment. Carve in means having additional guidance in Ind AS. Removal of option means having a just in IFRS there are some choice. We have cut down the choices and we have just taken one view, one choice, one option. Okay, so it is known as a removal of option, right? So if I talk about carve out, there are 8-9 carve out. If I talk about carve in, there is one carve in. If I talk about removal of option, so hardly there are 3-4 removal of options, right? So India has converged to IFRS. That is why we are calling it as an Ind AS. And the difference between IFRS and Ind AS is carve out, carve in, and removal of options. This removal of option is also known as curtailment of options, right? Where are we moving? We are moving from old accounting standard to Indian accounting standard, and we are moving towards global approach, right? Because our financial statement, our Ind AS is 99% replica of the global standard, right? We are moving towards fair value approach, and let me tell you, out of 39 Ind AS, more than 15 Ind AS talks about fair value approach. More than 15 Ind AS, okay? It talks about fair value approach, and there is one standard Ind AS 113, which is specific standard that how to calculate fair value, how to measure fair value, right? We are moving towards more of accounting, more of reporting than only accounting. if I compare my Indian financial statement, which is 30 or 40 pages financial statement, but if I'll convert this 30-40 pages accounting standard financial statement into Ind AS or IFRS financial statement, automatically it will become 60 pages financial statement. Why? Because there is hell lot of disclosures in IFRS and Ind AS, detailed disclosure in IFRS and Ind AS, which makes your financial statement more thicker, right? So it is more towards reporting rather than only accounting. Substance over form. Although substance over form is one of the important part of every gap. When I say gap, generally accepted accounting principle, but in India, in Ind AS, this substance over form is beautifully integrated in all the standard. If I talk about financial instrument standard Ind AS 109, this substance over form concept is there. If I talk about consolidation Ind AS 110, this substance over form concept is beautifully there. Revenue Ind AS 115, leases 116. So in all these standards, the substance over form prevails, right? Principle based versus rule based standard. Yes, these standards are principle based standard. Lot of judgment is required, lot of subjectivity is involved. It is not a rule based, it is principle based standard. And why we have used or why we have adopted Ind AS, why we have converged IFRS in India? Because this IFRS is used in more than 150 countries, either by way of adoption or by way of convergence. One language will enhance the comparability. One language will enhance comparability, understanding, and one set of books, right? Easy access to global capital market, which will attract foreign investment in low cost of capital. For example, in Dubai, the interest rate is 3-4%, and I want to have a capital raising in Dubai. So if I have prepared my financial statement under Ind AS, so hardly it will take another 15 or 20 minutes to convert this financial statement into IFRS, right? So these standards are more transparent and more visible. Why? Because there are a lot of disclosures here. In India, while drafting Ind AS literature, we have done a very beautiful job. ICAI has done a tremendous job. And wherever IAS standards are there, international accounting standards are there, like IAS 1 to IAS 41, these 24 IAS, we have issued Ind AS 1 to Ind AS 41, right? For example, instead of IAS 1, we have issued Ind AS 1, IAS 2, Ind AS 2. IAS 3, 4, 5, 6 is not there. So we have not issued Ind AS 3, 4, 5, 6. We have maintained the same sequence, same series. Okay. So wherever IFRS standards are there, like IFRS 1 to IFRS 16, we have started with Ind AS 100 plus 1. For IAS, Ind AS 1. For IFRS 1, Ind AS 100 plus 1. So Ind AS 101, 102, 103, 104, so on and so forth till 116, right? And wherever interpretations are there, we have just incorporated interpretation as a part of appendix, which has been incorporated at the end of every standard. For example, we have finalized Ind AS 16 property, plant and equipment. So whatever interpretations were related to fixed assets have been incorporated as an appendix at the end of the fixed asset standard, right? So I have also given, as a part of my deck, I have also given the Ind AS on the extreme left side. Ind AS numbers are there. In the middle, IFRS numbers are there, and on the extreme right side, IGAP numbers are there, right? For example, Ind AS 1 talks about presentation of financial statement. In IFRS, it is IAS 1. In IGAP, it is AS 1. So on and so forth. If you see this entire series, I'll not read this series. Okay, you can just have a look, and you will have a PPT for that. Okay, so if you will see here, you will not find a lot of IGAP standard, right? You will find this IGAP standard are missing at a lot of places. Okay, this is missing at a lot of places. So why these are missing at a lot of places? Because our old accounting standard are only 27 accounting standard, 27 AS, but our Ind AS are 39 Ind AS, 39 Ind AS. So we have 12 more Ind AS, we have 12 more guidance. So let me talk about the new guidance under Ind AS. So Ind AS 27, it talks about separate financial statement. We don't have any guidance on separate financial statement. Ind AS 29, see, hyperinflationary economies like Zimbabwe, Venezuela, Ghana. So if a company is operating into hyperinflationary economies, how this accounting and reporting has to be done? So there is a specific standard Ind AS 29 which talks about financial reporting in hyperinflation economies. There are three standard on financial instrument: Ind AS 32, Ind AS 107, and Ind AS 109. In India, there are no any accounting standard on financial instrument. AS 30, 31, 32. These standards were issued but never become mandatory. These were recommendatory in nature. We only have a guidance note in terms of accounting for derivative contracts, but we don't have any accounting standard. If I talk about agriculture, India is having an agriculturist economy. India is an agriculturist economy, but we don't have any accounting standard on agriculture. But in Ind AS and IFRS, we have a standard on agriculture, that how to recognize, how to measure agriculture produce, how to measure biological assets. Okay. Share-based payment, a specific standard under Ind AS. In IGAP, we have a guidance note. Insurance contract, a specific standard is there. In IGAP, in accounting standard, we don't have any accounting standard. We have a guidance note. Ind AS 106, it talks about exploration for and evaluation of mineral resources. So we have a guidance note on oil and gas producing activity, which have been prepared for Reliance and ONGC, right? But in accounting standard, we have Ind AS. In Ind AS, we have Ind AS 106. There is a specific standard on fair value measurement, Ind AS 113. This standard was not there in accounting standard regime, right? So we have 12 more standard in Ind AS, right? We have more guidance under Ind AS. We have more clarification under Ind AS. So this was overview of Ind AS. Coming to the roadmap in India. So let me summarize the applicability of Ind AS in India. In India, there are two standards: accounting standard and Ind AS, right? Accounting standard and Ind AS. First of all, Ind AS is not applicable. I am talking about not applicable. Ind AS is not applicable to non-corporate entities. Ind AS is not applicable to non-corporate entities, right? Non-corporate entities. Which entities are non-corporate entities? Your sole proprietorship, partnership, HUF, Hindu undivided HUF, body of individual, trust, association of person, right? On these kind of entities, Ind AS are not applicable. Doesn't matter if Rahul Chand and Sons, they have 1,000 crore of net worth, even though Ind AS is not applicable. So Ind AS is not applicable to non-corporate entities, right? Sir, then what is applicable? Accounting standard is applicable. So Ind AS is not applicable to non-corporate entities, right? Non-corporate entities, which is applicable, accounting standard is applicable. Ind AS is not applicable to bank and insurance companies, right? HDFC Bank Limited, Ind AS applicable, not applicable. ICICI Bank, Ind AS not applicable. State Bank of India, Ind AS not applicable. Sir, LIC of India is coming with an IPO, Ind AS applicable, not applicable. So banking, insurance, non-corporate entities, Ind AS not applicable, right? Sir, foreign companies, for example, Reliance has a lot of foreign subsidiaries. On foreign subsidiaries, Ind AS applicable. Ind AS is not applicable on foreign companies, right? Sir, if a company is listed on small and medium enterprise stock exchange, Ind AS is applicable, not applicable. So guys, Ind AS is not applicable on non-corporate entities, banks, insurance companies, SME listed entities, foreign companies, foreign entities. Ind AS is not applicable. Sir, on LLP, Ind AS is applicable. Ind AS is not applicable to LLP as well. Sir, then Ind AS is applicable on which set of entities? So Ind AS is applicable only on corporate entities. Sir, which set of corporate entities? So Ind AS is applicable on all the listed corporate entities. On all the listed corporate entities, right? All listed companies. I'm talking about today's scenario. I'm not talking about 2015, 2016, right? Ind AS was notified on 16 February 2015. So today, Ind AS is applicable on all the listed entities. Sir, Renew Power Limited. Renew Power is an Indian company, but Renew Power is listed in NASDAQ. Sir, whether Ind AS is applicable to Renew Power? Yes, Ind AS is applicable to Renew Power. If an Indian company is listed anywhere in the world, then Ind AS is applicable in India on that company, right? Sir, what about unlisted entity? If unlisted entity is having a net worth of more than 250 crores, 250 crores or more, then Ind AS is applicable, right? So Ind AS is applicable on this set of entity, right? Sir, what about NBFC companies? On NBFC company, Ind AS is applicable on NBFC companies, on all the listed NBFC companies. For example, HDFC Limited is an NBFC. So Ind AS is applicable on such NBFC, right? Sir, what about unlisted NBFC? On unlisted NBFC, Ind AS is applicable if the net worth is 250 crores or more. Okay. If Ind AS is applicable on such set of entities, then Ind AS will be applicable on their holding company, on their associate company, on their joint venture companies, and on their subsidiary, associate, and joint venture, right? Sir, what is the definition of net worth? So net worth has to be calculated as per section 2, subsection 57 of the Companies Act, and it means paid up share capital plus reserves created out of profit plus securities premium account minus accumulated losses, right? So Ind AS applicability part I have talked about. So Ind AS is applicable on the standalone as well as consolidated financial statement of the company. Sir, if a company has applied Ind AS because the net worth was 300 crores, subsequently due to COVID, the net worth was eroded to 200 crores. Whether Ind AS is applicable, whether Ind AS will still be applicable, or if the company wants to go back to accounting standard, whether it can go back to accounting standard, answer is no. Ind AS once applicable, then it will be applicable forever. There is no irrevocable option. Okay, there is no revocable option. It is irrevocable. Once you applied Ind AS even voluntarily, it will be applicable forever. Right? Is it clear to everyone? On overseas company, Ind AS will not be applicable, sir. But if Reliance has to prepare its consolidated financial statement, and Reliance has an overseas entity as a subsidiary, then how Reliance will prepare its consolidated financial statement? In that case, this overseas entity has to convert their accounts into Ind AS only for the consolidation purposes. Okay, only for the consolidation purposes. Like in case of HDFC Limited and HDFC Bank, on HDFC Bank, Ind AS is not applicable. On HDFC Limited, Ind AS is applicable. And HDFC Bank is associate of HDFC Limited. So HDFC Bank, for the regulatory purposes, is preparing their accounts under accounting standard. But for consolidation purposes, but for consolidation under HDFC, they are converting their accounts into Ind AS only for the consolidation purpose. And you will find this disclosure in the annual financial statement of HDFC Limited, whether they will write that HDFC Bank Limited, being an associate of HDFC Limited, has prepared the consolidated financial information which is fit for consolidation information in accordance with the recognition and measurement principle of Ind AS, right? So this is all about applicability of Ind AS, right? So I have covered my part. So we have discussed what is Ind AS, what is IFRS, how this IFRS has been converged into Ind AS, right? And we have also discussed about the roadmap and applicability of Ind AS. So there is one question by Shikhar Khurana. Why does USA doesn't go for IFRS? So Mr. Khurana, in United States of America, because they are one of the robust regulatory body, like as a financial accounting standard board of USA is concerned, and they are one of the oldest accounting body in the world. So for their companies, for their domestic companies, they don't want to adopt IFRS, but they have started a project in 2004, and they have started a project with alignment of US GAAP with IFRS. So that was the first thing. So in 2000, from 2004, this alignment was started from US GAAP to IFRS, although they are using US GAAP, but US GAAP and IFRS similar since 2004. Second one, in 2008, Securities and Exchange Commission of USA has allowed that non-US companies which are listed in US can file their financial statement in IFRS instead of US GAAP. For example, Renew Power Limited, for example, Infosys, and for example, Satyam at that point of time. So since 2008, they were filing their financial statement under IFRS instead of US GAAP. Okay. I hope I have answered your query. Let me see if there is any query on chat box. There is no any query on chat box. So thank you guys. Now CA Chandni Gupta will take over this session on Schedule 3 and major impact. So welcome, Chandni. Thank you so much, participants.
Thank you, sir. Thanks to Team Taxmann for organizing this session. Thanks to all the participants for careful listening. Now I will take the session forward with the explanation on Schedule 3 and major impact of IFRS. Let me just share my screen. Sir, can you stop?
Yeah, I have unshared my screen, Chandni.
Still showing. Yeah. Yeah, so participants, please confirm if my screen is visible.
Yes, it is visible, Chandni.
Okay, thank you, sir. Yeah, so now we will discuss the Schedule 3 and major impact of IFRS on Indian financial statements. First of all, I want to ask this question. Do we all know what Schedule 3 is and how many divisions are there in Schedule 3? Can somebody answer in the chat box? How many divisions are there in Schedule 3? Does anyone know? Any guesses? Any answer? Part A, balance sheet, okay. Part B, P&L. SOFP, SOPL, okay. 5, CFS, okay. Notes, okay. Okay, so first of all, what is Schedule 3? Schedule 3 is basically, it is not an accounting standard, it is not related to standards, but it is a part of Companies Act 2013. Companies Act, which is basically applicable for all the companies, right? Companies are registered under Companies Act 2013, and then only they are called as companies, right? So all the companies which are covered under Companies Act 2013, they are required to follow Schedule 3. This is driven from Section 133 of the Companies Act 2013. The section says that all the companies will have to prepare financial statements which are true and which give a true and fair view. How they give a true and fair view? They give a true and fair view when they are in compliance with Schedule 3 to the Companies Act and accounting standards as applicable. Right, so Schedule 3 is basically a schedule which gives guidance, which gives the format of balance sheet and P&L and general guidance on how to present the financial statements. Right, the minimum disclosures there are, the minimum line items on the face of balance sheet, on the face of P&L. So basically, Schedule 3 just gives a format of balance sheet and P&L, not of cash flow statement. Cash flow statement is not there in Schedule 3. It is driven by applicable standards AS3 or Ind AS 7. Right. So about Schedule 3, as I've told you, that this provides a format of financial statements. So there are essentially three divisions. Three divisions of Schedule 3. First, so as Alok sir has explained that how in India, as we speak, there are two sets of accounting standards, right? First is the AS, which were applicable since the beginning. And second is Ind AS, which were applicable from year 15-16. Right, so Ind AS is applicable to a certain set of companies. As sir has also explained the roadmap, so explained that all the listed companies and unlisted companies having net worth of 250 crores or more are applying Ind AS mandatorily. Some companies are applying voluntarily, their parents, subsidiaries, joint ventures, associates, all these companies are applying Ind AS mandatorily, right? And some companies on voluntary basis. So a set of companies are applying Ind AS, the other set is applying AS. Right, now, other than this, the NBFCs are also applying Ind AS, right? If the threshold has been met. So listed NBFCs and unlisted NBFCs having net worth of 250 crores or more are applying Ind AS. So in order to provide guidance to all these three sets of companies, first is companies applying AS, second, non-NBFC companies applying Ind AS, and third, NBFCs which are applying Ind AS. Right, so there are three divisions in Schedule 3. First is for companies which are applying AS, second is for non-NBFC which are applying Ind AS, and third for NBFCs which are applying Ind AS. Right, so these are the divisions of Schedule 3. So when you're preparing the financial statements, so when you're auditing the financial statements of any company, you first have to judge which division will be applicable, because the format of balance sheet and P&L differs for all these three divisions. right? So when you are preparing financial statements, you have to judge which division will be applicable, and accordingly the format will be decided, right? So now in this session we are discussing how Ind AS has impacted and how the changes have come, and also say with the introduction of Ind AS, Schedule 3 has also changed. Since then only this division 2 was introduced, right? So in Ind AS, it is imperative to understand what are financial statements, right? What is a complete set of financial statements? So first of all, the balance sheet is there. So we all know what balance sheet is, right? Then there is statement of profit and loss account. So that also we all know what statement of profit and loss is. Third is statement of changes in equity. Now this is something new, right? This we have not heard before. This, in short, this is called as SOCI, statement of changes in equity. So basically what this statement is, this is an additional statement in the Ind AS regime, and this statement shows nothing but the changes of the movement in reserves and surplus. Okay, first of all it will show you the changes or movement in equity share capital, and then it will show the movement in reserves and surplus, all the reserves, capital reserve, general reserve, retained earnings, right, other comprehensive income. So it's just a statement separately prepared to show the movement of reserves and surplus. Earlier in AS, we used to give a schedule or a note to show the movement in reserves and surplus, but in Ind AS there is an altogether a different statement for it. All right, so this is an additional statement. Then statement of cash flows, that we all know, CFS. Then notes are a part of financial statements, comparative information for the preceding period. And then this is third balance sheet. Now this is also something new, right? Because we have not heard about third balance sheet ever. Now what this is, so third balance sheet is not prepared every time. There are certain exceptional cases when third balance sheet is required to be prepared. Out of these, first is when there is a change in accounting policy and it is applied retrospectively. So basically, accounting policies are supposed to be applied consistently, right? From period to period. The companies cannot change the accounting policy whenever they want. There has to be proper justification behind it. There has to be reasons behind it, right? And when they do change the accounting policy, it is made applicable retrospectively. What is retrospective? Retrospective means from the beginning of the period, or from the initiation, right, as far back as you can go, right? So when there is a retrospective application of a change in accounting policy, in that case a third balance sheet is prepared. Now what is third balance sheet? So suppose you're preparing financial statements for year 2021-22, right? So you will prepare a balance sheet for 31st March 2022, right? Comparative, you will give 31st March 21. But if there is any change in accounting policy in year 21-22, then you will have to give an opening balance sheet of 1st April 2020. This is the third balance sheet. So in this balance sheet, you will take all the impact in retained earnings, which is caused by the change in accounting policy, and 31st March 21 balance sheet will be restated, and 31st March 2022 balance sheet will be prepared as per the new accounting policy, right? So basically this is the idea behind third balance sheet, that whenever there is such a change, the impact is taken in the opening balance sheet, and further balance sheets are prepared as per the new accounting policy, or assuming as if the new accounting policy was there from the initiation, right? So this was first case. Second case can be if there is any restatement in financial statement, which is also made retrospectively, or when any reclassification is done in the financial statements. So and also when there is a prior period error. So earlier in AS, what used to happen, if there is any prior period error, there was an additional line item in the statement of profit and loss as a prior period expense, but that is prohibited in Ind AS, right? You cannot show a line item on the face of statement of profit and loss, right? If there is any prior period error, you have to prepare a third balance sheet if it's material, the impact is material, right? And in third balance sheet, you will just correct that, and further balance sheet will be prepared as per the correct numbers, right? So this is the concept of third balance sheet. So these 7 items essentially comprises of the complete set of financial statements essentially comprises of these 7 items, right? So now moving on to understand what is the change in format of balance sheet and P&L, essentially balance sheet, when we move from AS to Ind AS, right? So basically, when you are looking at the financial statements of any company, you can judge that whether this company is applying AS or Ind AS. It is that visible, right? So in IGAP, which is the division 1, IGAP means AS, right? So if the company is applying AS, they will have to apply division 1 to the schedule 3. So in division 1, the format of balance sheet was such that equity was on top, then liability, and then assets. But in Ind AS, on the other hand, assets are on top, then equity, and then liability. So the so basically, the entire balance sheet has been turned upside down, and you can just judge by looking at the balance sheet that whether this company is applying AS or Ind AS, whether it is applying division 1 or division 2. Right. So this will be very helpful. This information will be very helpful for you to judge the financial statements of any company. So just to show you how it looks like, this is an extract from the balance sheet of Hero Motocorp. Right. This is the balance sheet for year 2015 when Ind AS were not notified. Right. And the Ind AS were not applicable. So the company was applying AS. Right. Which means the division 1. So here you can see equities and liabilities are shown first and then assets. But as compared to that, when in 2017, the company applied Ind AS, the balance sheet format changed completely. Assets came first and then equity and liability. And now you'll notice that the company has shown 3 balance sheets. As at 31st March 17, as at 31st March 16, and as at 1st April 2015. So when there is a first time application of Ind AS, then in that case also the third balance sheet is prepared, right? So this is a classic example. Like this happened with all the companies when they when they adopted Ind AS for the first time, they all prepared the third balance sheet, which is the opening balance sheet of the preceding year. Right? I hope this is clear. Now, how the Schedule 3 changed from the very beginning. This is just a timeline of the Schedule 3, the history of Schedule 3. Earlier, when there was Companies Act 1956, there was an old Schedule 6, right, which allowed both vertical and horizontal form of balance sheet. You remember there was T format balance sheet, assets and liabilities, right? That was also allowed. But then in 2011, from 1st April 2011, they revised the Schedule 6 and they allowed only the vertical format, right? And then going forward in 2014, when when Companies Act only got revised completely, Companies Act 1956 was replaced by Companies Act 2013. They changed the Schedule 6 and introduced Schedule 3, right, which was made applicable from 1st April 2014. So which is applicable to companies which are applying AS. And then in 2016, they introduced Division 2. Why? Because by then Ind AS were introduced. So this Division 2 was made applicable to all the companies which are not NBFCs and are preparing financial statements as per Ind AS. Right. Then Schedule 3 was introduced in 2018 because by then the Ind AS were applicable to NBFCs. So for NBFCs which are applying Ind AS, they introduced Division 3 to the Schedule 3. And then the amendments came in all the 3 divisions. So this is essentially the entire history of Schedule 3 and how it moved from vertical and horizontal format to having 3 divisions specifically for AS, Ind AS, non-NBFC and NBFC Ind AS. Right. So I think this will help you to understand the financial statements. Now moving on to understand the impacts on financial statement of IFRS or Ind AS. Right, so this we have discussed that the format of financial statement has been turned upside down because this is the visible impact, right? You can just see this in on the face of financial statements. Second is explicit and unreserved statement of compliance. So as per Ind AS 1, the management is required to give an explicit and unreserved statement of compliance with all the Ind AS. What is this? This is basically just to make sure that the financial statements are complying with all the Ind AS. Earlier, it was not required. Earlier, only auditors used to comment that yes, the financial statements are giving a true and fair view. That means they are prepared in accordance with accounting standards. But now the onus has shifted from auditors to the management, and management in the first place has to give this statement of compliance in the financial statements, in the notes to the financial statements. Right, then this third balance sheet concept we have already discussed. The presentation of statement of changes in equity. This also we have discussed. This is a separate statement introduced. Concept of other comprehensive income. So basically, other comprehensive income is an additional section in the statement of profit and loss. There are two sections in statement of profit and loss. First, which shows the P&L, and second, which shows the OCI. Now, what is this OCI, other comprehensive income? Basically, other comprehensive income in this section, certain items are reflected which are not routed through P&L, or which may be routed through P&L at the end of the term of the item, maybe asset or liability or whatever. Right. So now, can we show any expense in OCI or any income in OCI? The answer is no. Why? Because the standard will tell you that, okay, this item will be routed through OCI. For example, Ind AS 16 on PPE will tell you that revaluation, upside revaluation on PPE will be routed through OCI. Okay, so certain items will be routed through OCI as per the specified Ind AS. You cannot just show any item in OCI. Okay, so for that you'll have to go through the specific Ind AS and understand which standard is asking you to reflect any item in OCI. Okay, so this is essentially a separate section, and it is shown as a part of other equity. So when you prepare a statement of changes in equity, there is reserves and surplus, and OCI. So both these movements are shown in statement of changes in equity. Right, then Ind AS requires classification of current and non-current assets and liabilities into financial and non-financial items. So as you can see in this balance sheet also, earlier there was current liability and non-current liability, right? But now when you see the Ind AS, you can see financial, like non-current and current are always there. But in that also, there is a sub-classification of financial assets and all other which are non-financial assets. So similarly in current, you can see financial assets. Then in liability also, you can see financial liabilities. So basically, the standards, in Ind AS, the assets and liabilities are also bifurcated into financial and non-financial assets and liabilities. Why? Because for financial and non-financial assets, for financial assets and liabilities, the treatment is slightly different. There are disclosures associated to these items which are required in the financial notes to the financial statements. So the classification and in order to understand that how many financial assets and liabilities are there in the company, because a financial asset is basically showcasing that the company has a right to receive some cash in future, and a financial liability is showcasing that the company has an unavoidable obligation to deliver cash in future, right? So this will give a more holistic view, a more it will give a better understanding to the users of financial statements. Now there are further more impacts. For example, under Ind AS, if there is any non-adjusting event which occurs after the reporting period, it is shown in the financial statements itself, in the notes to financial statements. Earlier, it was shown in the report of approving authority, right? So whenever there is a non-adjusting event is basically an event occurring after the balance sheet date, but before the approval of financial statements, right? But the impact cannot be taken in financial statements because it is not an adjusting event. Right. So earlier it was shown in approving authority report, like not earlier, but as per AS. But in Ind AS, it is required to be shown in the financial statements. Right. Then there is discounting of provisions. So we have never done discounting of provisions. In AS, we only provide for items and on the face value, right? But in Ind AS, you have to discount the provisions if the impact is material, if the impact of time value of money is material, right? So if you have any obligation, a probable obligation, say in 10 years from now, so you can provide for that cost today, but you will have to account for time value of money. You cannot provide, say, 3 crores, which you are expecting in 10 years today. Right, you have to provide maybe for 2.5 or whatever the discounting, maybe use 10% interest rate or whatever the market rate is there. Use the discount rate, calculate the present value of 3 crores and make a provision today, and then charge the interest in PNL, so that at the end of 10 years, the amount reaches 3 crores and you can just go ahead and pay the liability. Right. So discounting of provisions is a new concept in Ind AS, but obviously the standard clarifies that if the impact is material, then only you can do the discounting. Right. Then further, there is compound financial instruments. So we all are aware about the concept of preference shares, right? But earlier it was always shown in the equity share, not equity, but yeah, the share capital of the company, not at the liability side, but only in the equity side, right? But in Ind AS, the preference shares, a part of preference shares will be shown as liability now. Now this is a change. Why? Because now some portion of equity has been moved to the liability. So the debt of the company is increasing, right? This is a quantitative impact. Now, if the debt is increasing, obviously the key ratios will change. Say the debt equity, interest coverage ratio, right? So all these ratios will change. So in Ind AS, if there is the preference share can be a compound financial instrument, which means that it can be equity and a liability both, or it can be completely a liability, or it can be completely equity. So there is a whole concept behind it, that how do you evaluate whether a preference share is a compound financial instrument, or just an equity, or just a financial liability, right? So there is a whole concept behind it, but just to give an overview, this is an impact of introduction of Ind AS, that now that some part of equity has been moved to liability. Right. Then, as Alok sir has also explained, that in Ind AS, like out of 39, maybe more than 14 standards are based on fair value concept, right? So in Ind AS, obviously fair value concept is very, very popular, and it is actually based on fair value concept. All the items, like essentially all the items are shown at fair value, right? There is a standard, there is specifically a standard dedicated to fair value measurement, which is Ind AS 113, converged with IFRS 13. And the standard explains, it does not give you any a recognition or measurement criteria, but it just explains that how do you arrive at fair value, and certain disclosure requirements associated to that, right? So there is a dedicated standard just to explain how the fair value will be calculated for other standards. See, if you are if there is a PP and you have adopted for evaluation model, then how do you calculate the fair value of that particular PP? That will be guided by Ind AS 113. Right. So this is this much this is the penetration of fair value in Ind AS. Then extensive disclosures, as sir has also explained, in Ind AS regime, the disclosures have become so important that earlier, not earlier, but AS balance sheet or AS financial statements maybe for like 30-40 pages, but Ind AS financials will be maybe for 100 pages. Why? Because of the disclosures. Right, there are two standards dedicatedly on disclosures only. These standards do not talk about measurement criteria, recognition criteria, nothing, but they are only on disclosures. Ind AS 107, which is on disclosure of financial instruments, and Ind AS 112, which is on disclosure of consolidated financial statements. So these two standards are dedicatedly talking only about the disclosures. So now we can guess that how disclosures are important in the Ind AS regime, right? Then substance over form. This is a phrase or term that we all are aware of. Now you'll say that this is also there in AS. Why are you putting it here in Ind AS impact? This is nothing new. But no, this is new. Why? Because in AS it was always a term, but it was not practically applicable. I would say, right? But in Ind AS, standards are actually based on the concept of substance over form. For example, revenue. Now, earlier revenue was recognized when, say, the delivery is happening, or when, say, the sale is happening. But in Ind AS, revenue is being recognized when the performance obligations are being satisfied. So there is a 5-step model, right, to recognize revenue. It's not just that you have delivered goods and now you can recognize revenue. No, there is a 5-step model. You have to evaluate the collectibility of the revenue. You have to evaluate the performance obligation satisfaction. So all of these criteria are there that you have to evaluate before you recognize the revenue. Then leases. The leases standard was completely changed in year 2019, and this is a classic example of substance over form, because earlier when we had any lease, the lessee was classifying the lease into finance lease and operating lease, right? Finance lease was shown on the balance sheet, the asset was recognized and a liability was recognized. But in operating leases, the lease was not shown on the face of balance sheet, right? The expense was recognized on a straight line basis in P&L, that's all. But now in the new standard on leases, it says that lessee, if you look at the substance of a lease, the lessee has the asset, right? It has the asset, it has the right to use that particular asset, and it has a future obligation, be it finance lease or be it operating lease, doesn't matter, right? There is a liability on the party, there is an asset to the party. Why not show in the balance sheet? Why do you have to classify finance lease and operating lease? And why do you not show the operating lease on the balance sheet when you still have the asset and still owe the liability? Right. So by going by the substance, the standard completely revived the accounting for lessees, and it scrapped the classification, and now all the lessees are required to show their leases on the balance sheet. Like for all the leases, they have to recognize an ROU asset, which basically showcase that the lessee has a right to use an asset, and a corresponding lease liability, right? Then financial instruments, business combinations. So basically the substance over form is ruling the Ind AS regime, and the transactions and the accounting is actually showing that the substance is being valued over the legal form. Right. Then obviously the extensive use of management judgment, because these standards are principle based and not rule based, as sir has also explained. And management is now required to monitor the environment, the industry, the economic environment and everything. Why? Because obviously first reason is because they have to monitor the fair value, because most of the assets are being recognized at fair value, right? If there is any change in the economic environment, there may be an impact on the fair value. Then obviously the estimates have become more robust. The management has to be aware of the changes, and they have to take the impact in the estimates also, right? So yeah, and then additional guidances. So basically, Ind AS has actually introduced so much additional guidance on certain topics which were never there in AS, right? For example, insurance contracts, hyperinflationary economies, fair value measurements, regulatory deferral accounting. For share-based payment, now they have a guidance note, but not a standard. But in Ind AS, there is a standard, right? For financial instrument, there is no guidance note, there is no standard. But in Ind AS, we have 3 standards dedicated to financial instruments, right? So I think with the introduction of Ind AS, the financial statements of the companies have become more robust. They give a better, more true and fair view, right? There is principle based guidance, but yes, there is guidance on specific and exceptional items. And yeah, with the use of fair value, I think the financial statements are up to date. They are being updated on real-time basis. And yes, the impact has been huge. No doubt the debt of the companies have increased, because with the change in lease standard, also the debt increased significantly for certain industries. But I think that that was all for a betterment. So yeah, so that will be all from our side. I think we've just overrun on the time, but if you have any doubts. I think there is one question in the chat: what all accounting policies are applied retrospectively? So so basically accounting policies are applied consistently from period to period. But if there is any change in any accounting policy, they are all the impact is taken retrospectively. Okay, I hope that helps. Why there is no specific accounting standard for accounting and recognition of crypto, as well as for valuation and disclosure. Also, no provision in Schedule 3 held for trading or otherwise. Guidance is also not available. So yeah, I think for crypto, so basically in Ind AS, no, there is a guidance that if there is no particular standard available for a particular transaction, you can derive you can come up with your own analogy, and you can derive the guidance from other accounting standards, or you can go and refer IFRS also, right, in a particular manner.
So just to add on for cryptocurrency, as Chandni has rightly mentioned, if there is no specific guidance, then you have to go with a similar guidance. So you have to see whether you need to take it as an inventory standard or you need to take it as a financial instrument standard. And coming to the held for trading, so held for trading, there is a guidance which is available. If something which is held for trading, of course, within the ordinary course, it will be classified as an inventory. And if it is held for trading business model in financial instrument standard, so you have to take the accounting in that manner. So if something which is held for trading like a financial asset, it has to be classified as a FVTPL.
Right. Thank you, sir.